Swordsman here. It's May 21st, 2023. This video will be about revisiting volatility and why, again, doesn't make much sense to be crying or whining about volatility without, at least when there's no reason for it or there's no underlying reason for it. The important thing for a value investor or a growth investor is always the signal. Price is our tool. Changes in price is our tool. Me as a fully invested investor, volatility is oftentimes the only way I have to actively, change my portfolio, increase my returns, and in lack of a more dry powder, because obviously dry powder, if you have $10,000 invested and you can invest $100 more, assuming you pick on average play with positive expected returns, or you pick a basket of positive expected returns, your portfolio will go up. So obviously dry powder in a high future expected return environment, which we are in now, is highly valuable. I mean, personally, at these extremes, which we don't see too often, maybe once every a few months every 8 years or so, I think dry powder is extremely valuable right now. And I don't mean having dry powder. To me, I would say it's deploying dry powder, because the way I look at any stock price or any stock or investing or investing overall, is that I will put money to work as long as I find something worth putting money in. When this sector is richly valued, the future expected returns are lower, so it becomes higher to find a story where you think over the next 1 to 2 years, let's say, money invested there is expected to do better than holding cash. And right now, from a sentiment perspective, we're in the aces category. It's hard, or at least kings. It's hard to get a worse sentiment environment than this. It's worse to get cheaper prices on a broad scale, meaning we're sitting with kings here. I'm investing on average in kings almost by default if it's an above average junior. So you have two things working for you right now, I would say, or there's two things that I keep in mind. A, where we are in the sentiment cycle, the cheaper things are, the worse it feels, the less people are interested. Everything will typically trade at a very cheap price. That makes life a lot easier for me, because it's much harder to be making a mistake as a value investor right now than during the top in 2020, because at that point many juniors probably were fully valued or overvalued. Right now it's very hard to find something that is overvalued, unless it's a crappy company, which should and is expected to go to zero on a long enough timeline. Then you obviously have the stock picking aspect, where it's like, yes, you can have 10 juniors that are cheap, but 3 are cheaper than the other 7, and cheapest of them all, let's say. So there's, I think, plenty of opportunities out there which have like 200+% expected returns, but it would obviously be better to find ones where the future expected returns are 300% over 2 years. So I mean, in a sense, you're gonna do well regardless, on average, if you have a reasonably diversified portfolio of good bets, even though they might be high risk, high reward. Still, one would obviously want to be in the cheapest ones out there with the highest possible expected return. So again, from a macro sentiment perspective, I know I need to be deployed. I mean, I know there's a lot of people who are sitting with a considerable amount of cash on the sidelines. I personally don't understand that, especially at a time like this, because again, if you're right that there will be even lower prices, even more, I mean, that juniors that you expect will do 300% over the next 2 years, they might do 400% from a lower price point to start off with. That would be even better, obviously. I mean, I would love to be able to only put money at work when my future expected returns in an average junior that I like is 400% rather than 300%. But the thing is, since you cannot guarantee that there will be even better prices, if you're not deploying capital when it's expected, let's say 300%, closest to the best it's been in the last 8 years, that is to me real gambling, because you know how good the opportunity is right now, but you cannot guarantee the opportunity will get better. So if you don't pick up this opportunity, worst case scenario, we don't have lower prices, or you for some reason miss the lower prices. You don't get in time. You think they're gonna get even lower before you actually take advantage of it, and maybe the prices jump up again. So yes, you got a chance to get in even cheaper, but for some reason you might not. You thought they would go even lower, let's say, and they rebound higher, and maybe even higher than when you decided not to buy in the first place. So the way I see it is that if I have kings, I'm not folding them. I'm not gonna play that hand simply because there's a chance I might get aces. Because then you would be folding, pretty much every hand, and you would never play. So you would be missing all the opportunities. You get dealt kings, don't play it. You get dealt queens, don't play it. You get dealt ace king, don't play it. You get dealt jacks, don't play it, etc., etc. In poker, you would play every hand as long as you thought it had positive expected returns. You would prefer to have aces, obviously. But if you get kings, you're for sure gonna play kings, because that's the second best hand you can have. So I would never, again, not jump on an opportunity because there's a chance that the opportunity could get even better. That makes absolutely no sense for me. Like I stated before, it's like if you're wrong and prices actually don't go lower, or they stay around this level and suddenly jump up, and you were not in it because you were hoping for an even better opportunity. I mean, that again, to me, that is absolute greedy. Anyway, if you're wrong and you didn't buy, and all of a sudden the bottom is in, you didn't buy when there was a 300% expected return, which would be, I mean, you can't add, let's say it takes place over 2 years. That is an insane return for 2 years. Again, the market average is 8 to 9% per year. So to me, we've been in no-brainer buying territory for a year, I would say. So I'm always full invested, but what changes is that when sentiment is high and prices are high, it's harder to find cheap bets where the expected average return is up, because we've seen cases like Snowline, Newfound Gold, early on in SK, Eloro. I mean, during the discovery phases, etc. Even if prices of metals fell, they went higher. You would have missed that if you decided, well, I think gold and silver is gonna go down. Even if you were right, you'd have lost out on those opportunities because they went higher regardless of what the metals did at the time. So there's always hands out there to play. It just means that when prices are high, it's much harder to find a stock where you think that, hey, money is better spent here over the next 2 years, if I had to guess, than in cash. So, and on the point of volatility, okay, how do you create a 10-bagger? That is not a static thing. The thing that creates a 10-bagger is reality happening at a certain point in time in the future. And the difference, and what actually a 10-bagger is price goes up 10x. So how can you create a 10-bagger? I mean, that's a 9-bagger that goes down in price. That's an easy way to create it. So, to to show what I mean by that, it's like, let's look at Patriot Battery Metals. I think this became a let's say a 30-bagger over 30-bagger and a 20-bagger over 1.5 years approximately. Okay, the signal is the value. That's what I keep saying. Price will fluctuate greatly. Sometimes it's because of changes in fundamentals. A lot of the time, these swings get exaggerated by trend followers and sentiment, etc. So I mean, just look at this. Like here and I haven't listed all the news. I mean, from this point here, they probably put out like 40 news releases or something. That's the fundamentals happening. Something changes when news comes out. Other than that, assume nothing has changed at all. So, here for example, 30th of May 2020, price was here, and less than a month later, 15 days, price was here. Until the top later on, this opportunity here turned out to be a 3-bagger opportunity. Within 15 days of trading, Patriot Battery Metals presented anyone with an 8-bagger opportunity. In hindsight, we don't know that for sure in the future, obviously. But again, assuming because Mother Nature didn't change, the Corvette project didn't change from this period here. It just more got revealed. The signal, the value trend was up because they kept on hitting. That is the, in my opinion, important thing, because you can see again, like in Great Bear, which I'm gonna show later, you could have bought every single top. As long as the value creation was net positive, and preferably, a long runway. And of course, it's much easier to grow something from 100,000 ounces than 5 million ounces. It's way easier to double. And the same goes for lithium. I mean, it's easier to go from 100,000 tons of lithium to 200,000 tons than 10 million ton lithium deposit to 20 million ton lithium deposit. My point here is just imagine the differences in expected future returns. And this played out over 15 days. And here you have, from this point, this top here, Patriot Battery Metals became a 20-bagger for anyone that bought it here, sat on their ass until this point. And that wasn't even, a 20-bagger in... like 2.5 years. I mean, that's nothing. Or 1.5 years, I should say. Almost, a bit more than 1.5 years. 20 bagger from buying that top. Of course, they felt very dumb down here because that's a 70% retracement. Okay, how much did the actual value change? And of course, Mother Nature didn't change anything. What is present up there at the Corvette property right now was present back here, and has been present for millions and millions and millions of years. But information changes the probabilities of that being the case, obviously. But it's like September 23, Color's first hole. Then there was a profit-taking event for some reason. Maybe lithium prices dived, whatever. We now know today that's like the Corvette property looks to be one of the best, if not the best, undeveloped lithium project on Earth. So did it matter what the lithium price did for a period of time, or that the market was spooked, or whatever created this downtrend in price? No, we know now that it didn't really matter that if lithium went down or whatever. It's like if there's one deposit that's probably, be able to make money in a low lithium price environment, it would be the Corvette property. Still, price went down 73. So all of a sudden, that price decline created a 76 bagger. That played out over less than 2 months. That is just absolutely crazy, isn't it? This kind of return is enough for 10 plus years of investing, easily. More than that, maybe 15, 20 years worth of average market returns. I haven't done the math, obviously, but it's like incredible, just obscene. Probably even more than 20. Yeah, easily more than 20, especially at 8-9% per year. Still, this decrease in price created a 76 bagger down here. That is just absolutely disgusting. Within less than 2 months, a 20 bagger became a 76 bagger. Geology didn't change. They even have a news release here with spodumene pegmatites in every hole. And then right near the bottom here, completes inaugural drill program. So it sounds to me like they kind of, hit what they wanted to hit. So if you look at price, obviously if they color the first hole, there's less information here because they just color the first hole. Here we know that they hit spodumene pegmatites. So that's de-risking this target. But still, price is much lower than it was when it was more risky. And then they completed the inaugural drill program. I haven't totally read the news release. I have a very hard time that you could explain this price decline from a fundamental standpoint, given that it became more de-risked. So imagine how wrong the market was. In hindsight, it was 3,600% in added returns. No, I can't even do math today. 5,600% added. Do you understand how insanely wrong the market was? I mean, if the market is efficient, that's like I don't know how many sigma events that's got to be in terms of getting the fundamentals wrong in that case. It is just absolutely incredible how irrational this market can be. And again, here, within 15 days, the marginal investor in Peter Bell Metals created an 8-bagger from a 3-bagger because price went down. It's like I said a bunch of times before, I can afford to have corrections, big ones, as long as I just keep buying. When price has gotten cheaper, less is priced in, and the fundamentals does not warrant that kind of price decline. If an investor bought here just 15 days later, their returns would be obscenely different. This person here would get a 287% return, which is superb. This person here, 786% return. What does that mean? Obviously, it means that you need to be less sure about this working out here than here. Because, okay, let's say it doesn't work out as good as you hope. 287 here. So if Corvette ended up being worse than it actually ended up being, assuming the market, they would find something which the market would value today at $7.5 instead of those $17.5. You would have the same return. So the more room to the upside, the more you can miss. You don't need blue sky to play out in the same way. But if this person bought here and the reality was not as good as it turned out to be, they would obviously make a lot less and will need to be right on have a higher hit rate. So cheap prices, low prices, decreases your need to be right. Back here, buying this low, you would be happy if they find something worth $1.5 per share today. You would still be up 618%. And given what happened, it would be fun to calculate the odds priced in right here that this would happen. I mean, again, it basically was pricing in a total impossibility of Corvette becoming what it became. I mean, was it impossible? I mean, we know that 1 in every 1,000 prospects actually become a mine, etc. And we don't even know if this is going to become a mine yet. But we don't really need to answer that question yet, because that risk comes after the discovery risk, obviously. It's like there's no permitting risk unless you have something to permit. It's the same with, my points about Snowland early on. It's like, I don't know when Snowland's Valley deposit, is it for sure going to be economic? I think so. I mean, it looks highly, highly economic given the characteristics of those types of deposits and the apparent grade and size. But like, I know some people that immediately wrote Snowland off because it's, hey, it's so remote. Or they're not going to get that permitted. Who knows? But to expect that the market, to expect that the market won't care if they pull, 200-meter holes of 2 grams per ton, etc. In Yukon, from that price level that where Snowland was trading at, it's like, every hurdle has a time and place. And I just, felt that, hey, it's like nobody knows how the community relations or like the political landscape will be when Valley is in a state where it's like, now the only value additive thing you can do is to actually permit it and build a mine, when values mature. But that's a time and place. But again, it's like, I mean, if you just buy cheap when a store is intact, you don't need to be right often at all. If you had like 2% in Patriot battery metals and just went away for 2 years, you let it play out. You thought it's like, hey, fire and forget. Either this, these spodumens that they hit, either they're gonna become something or not become something. And even if it becomes something, I don't know, relatively small, you might win. You can only lose 100%. That's the thing. That's the risk reward. When prices go down, warranted by the fundamentals, the risk reward increases. Because if things turn out, I mean, price declines doesn't change geology. So if this Dixie deposit, etc., is going to turn out to be a big one, you obviously are going to make more from this level than this level. So you can afford to have more great bears that go from here to here, because the ones that actually work out going from here to here, they'll pay for many, many more great bears that didn't find anything and got cut in half or down 100%. So it's like, this is the best protection and or best offense and defense is just buying intact stories as cheap as possible. Less times at this kind of cheap price when the upside potential is, again, we know this in hindsight, but it's to the tune of this amount. Even if you thought it had a 10% chance of happening or 15 or whatever, that would probably be a very good bet. Up here you might need, I don't know, 30% chance of success. It's like I'm just throwing numbers out there, but I hope my point gets across. When the price today widens towards the theoretical future value, you can make more, and that means you need to be right less often, pretty much. Again, with some kind of diversification, because otherwise, if 100% downside is always a risk, theoretical risk, even though there's many juniors that don't fully go bankrupt unless they have debt still. I mean, it goes without saying. It's like if you bought here, went all in Great Bear. I don't know what the exact market cap was, but maybe there's like, I don't know what the blue sky, I mean, I think they get paid pretty good. And in that case, there's like, 50% upside. But obviously it's harder to quadruple the value of something relative to price if price is at, 1 billion or, 1.2 billion, etc. But obviously what happens is that even if Dixie or the Great Bear assets didn't turn out to be valued this much, if they at this point in time were worth at least this much, then it's like you don't have a margin of safety, but you still have a floor. I mean, what they found up to that point, it was probably never going to be worthless. So I mean, as value climbs, you at least have margin of safety climbing as well. Even though, yes, here it's more, worst case scenario, it doesn't grow anymore, and you have this downside drop here, even though we know that the actual market can go like this. But still, it's like this became kind of a chaotic video. Maybe I should redo it sometime. But it's like, my point is that prices change a lot without the signal, the value, the potential future value changing much at all. You can see a month where there's no news out, but prices can swing. It's like, Here it was at 415. Here it was at 220. I mean, a huge swing, obviously. I don't remember if there was any real news behind that. But still, I mean, even this kind of just a sentiment swing. Let's say, I mean, 418. Down here is like 777. Let's say, assuming nothing in terms of news has come out in Snowline from this point here. That was the market created started at a 5-bagger, future 5-bagger, and went down to almost an 8-bagger. So insane implications for the future and the risk reward and opportunity. Again, we don't know. This is what I mean when I say it's like opportunity cost is not looking in hindsight. Opportunity cost is 1 second. Opportunity cost, an opportunity is in the moment at all times. We don't know the future. The only thing we know is that if nothing has changed for Snowline and it was trading here, without knowing any other information than price going down here, we know by definition risk reward must have gone up. This must be a better gamble. Because if you need if this is going to provide 454% return, you obviously need less certainty that it will become that good if prices are down here, or you can have an even lower or a worse future. The project is a bit worse and you would still have the kind of same return here. So the bar is lower for a given return, the cheaper it is. But again, it's like, just look at this. It's like, I mean, how many people were happy, buying this? Let's say you have a trend breakdown here, and prices, downtrend is obvious. All of a sudden, it's like, they didn't know it at the time, obviously, but this was a 812% opportunity here. Down or up from a 288. But do you think people were happy about Patriot battery metals here? No, people were like, oh, I'm probably going, a lot of people were probably selling, and people were probably trolling the longs. And of course, in hindsight, you could have had the worst timing ever in this kind of time frame. You could have bought the highest point in between here and back here, and you would still have made a killing in Patriot battery metals. And it just keeps on going, because sentiment and how trend following works, it's always going to be there. It's like, I'm not saying that the fundamentals didn't go up and down as well the more information came out. I mean, who knows, maybe some news came up here and it's like the expected value went from here to here, or maybe here it went from, I don't know, here to down here, whatever. But it's like the trend following aspect and how people work, and that there are many traders, etc., and that we can, people get greedy and buy it up too high and sell too low, etc. So I mean, it changes way more than the actual value. It's like, this is how I see it, that this sector, and you've seen my Bear Creek chart a bunch of times, it's just like, when momentum gets going, it completely overshoots or undershoots the actual signal. Because if uptrend has started and has gone on for a long time, more people find reasons to buy without thinking about what the actual value is. So they will take it higher and higher, unsustainably high. Then the mean reversion happens, and then you all of a sudden come down where there's a long downtrend, which is going to get even more people to sell. Not understanding or thinking about the increasing undervaluation and increasing returns, because when the mean reversion happens, so you get trend followers, scared money, more trend followers, really scared money, and then one day those have sold all their shares. Price can't go down anymore because nobody's willing to sell any cheaper, starts to go up. and then it just goes back and forth. I mean, you can see this in any chart. You obviously have like huge corrections, huge rallies, etc. If you just knew that's like throughout this whole time you were looking at, I don't know, even if you didn't really care that much about price to value, even though I think you should, but it's like if you think at all times, like when it was down here, this was obviously a flash crash, so that's when people were really emotional. But still, it's like, here, do I think Great Bear could grow for the next year or two? Yes, okay, it's gotten cheaper. This is by definition then a better buy than here, unless expected value has gone down so much that this is actually as expensive or cheap as here, which is typically not the case because this market is not rational at all times. I mean, back here, it ended up being more than 100% wrong, or looking 100% wrong within just a few months. And again, it's like here, it's like the market turned out to be insanely wrong here. I mean, if we knew for sure what was going to happen with Corvette, what value it would be at today, for example, the price already back here should be up, I don't know, it's like here, depending on what kind of discount rate you would want to see. Obviously there were many unanswered questions back here, but I guess again my point is that you can afford to be wrong more often when prices are low. So it makes the market is easier because you need to be, you can be dumber, let's put it like that, if prices are just low. And if the case is intact, I mean, by definition, if there's no news out and prices go down, all else equal, that's just a better buy if you thought it was a buy at higher price. So again, like I said before, it's like assuming, let's say you have a 5% position in Patriot Better Metals here, and you think that's a fair stake, even though that's pretty high, early stage and all that. But let's say your conclusion is that, hey, it's worth 5%, worth putting in 5% of my position, and you figure out that, hey, I mean, price has gone down 70%, and nothing has really changed. It's actually perhaps gotten better because it's more de-risked. So if you were willing to have 5% here, and you would be happy having 5% because that would 20 bag. So let's say you had 100,000 portfolio, you had 5,000 invested, that was gonna 20 bag. Okay, so worth 100,000. Every other play you had in your portfolio could have gone to zero, and your portfolio would still be neutral today. But if you see volatility as a gift, this is either a gift to buy or sell, yada yada yada. In this case, in hindsight, it's obviously just varying degrees of gifts, because you would be in the green on every buy. This would be a great buy. This would be a much better buy, yada yada. We don't know that, of course, but assuming you have a pretty good conviction, you have the story, etc. So you figured out that it's like, hey, I think things are actually better now than when it was here just 1.5 months ago or something like that. Maybe your 5% position would have gone down to 2.5% position, and everybody would be bitching and moaning, and it's like, I just lost 2.5%. I lost or let's say 70% decrease. So I lost $7,000. Is that a big problem? Obviously, we now know that was just a paper loss. This would become a 20 bagger. The thing you were spitting and cursing about, having a position, having bought in here, in time, you would be bragging about that. So that's just one of those fascinating things. It's like when people say, well, lambast people, hey, you're stupid, you bought this, or it's like, if the fat lady hasn't sung, it's all a matter of, well, time and perspective. Because this person who bought here looked super stupid here. And probably felt incredibly stupid. Probably saying things like, I'm never chasing a stock again, or I always buy high, etc. Maybe he would have sold out here. Because he's like, oh, it's going to take so much time to get back. Still, again, this very position that went down 70% later turned around, and not too long after became a 20 goddamn bagger. So the worst buy ended up becoming one of the best buys in the entire sector. Simply from things playing out favorably and value being created at such a pace that whatever you paid here looked incredibly cheap in time. Because again, they can't prove up such a deposit like they have in a month. But if there is a huge deposit here, give them 2 years, and more and more and more will be revealed on, towards the point of there being, a world-class deposit. Even if Mother Nature didn't change, which it didn't, so it was a world-class deposit at depth already down here. But that couldn't be revealed in the first hole or the inaugural drill campaign. But you stuck with it thinking, hey, I think this could still grow. I think this could still grow. So just at all times you might look, it's like, hey, this price, I think there's a good shot this is going to look cheap in the future. And again, the earlier you are, the lower price you paid, the more wrong you can be. Even if the value creation stopped here, if you bought here, you would obviously be up a lot. So even though it didn't become a world-class deposit and or value stayed down here, whatever, that's still 136 to 130, 140. That's a 10-bagger. So you could miss the current version, AK Blue Sky, by a mile, and you would still have made bank. But from this level, you wouldn't get a 10-bagger if this scenario happened. You would get, 100%, a double. That's still a, great return in that time frame. But good things happen when you buy cheap. Oh, yeah, back to my point. So if you had 5% here invested, that went down 70%. So your 5,000 went down to what's that? Like 1,500. You would be cursing. You would only have 2.5%. A 2.5% position in less than that, 70%. God damn it. Still, if you understood that if it was worth 5% of your portfolio here, and this happened with price, and you think that, hey, I actually think it's more de-risked now. There's a higher likelihood now with this information, these two news releases, makes it a higher probability that it could be worth this much, or this much, or this much, or as much as it's the market deems it to be worth today. The risk reward just got incredibly better because price went down when the probability of upside went up. So if you started with 5% here, maybe you thought that this is so crazy good now, it's easily 3 times as good of an opportunity with this kind of price and with this news than at this kind of price with just the news of they call it the first hole. So maybe your position goes down 70% from 5% to was like 1.5% position, but you jack that up in that case to 10%. Let's say you're a bit conservative, even though that's a pretty big position. Still, if you're at 10% here and that's 76 bagged, imagine, That is absolutely crazy. You would need a 10 bagger to be neutral, 20 bagger to double your entire portfolio, etc. So you multi-bag your entire portfolio with a 10% position, thanks to price going down when fundamentals actually increased. So the question then is, was this a bad thing that happened? The person who took this bet surely shouldn't have thought so. Because if this price decline never happened, he would never get a 76 bagger opportunity. But compare that to the person who buys here, thinks he's dead wrong here, or sells out of fear or whatever, which is the case for most people. Then it became a curse. Because this guy just shaved off 70% of his 5% position, then sold out. So again, the exact same short, two different people, two completely different ways to look at price, value, and investing strategy, risk reward, etc. So one man's absolute curse and a negative drag on his long-term returns because he took a 70% paper loss and made it into a permanent loss by selling. Is another man's golden treasure, the best opportunity he might ever see in his lifetime. You, of course, again, you don't know that for sure, but it goes, from common sense that if the signal, the value trend is still up and things are getting better and price is down, that's by default a better opportunity. Of course, it could have started with a very high overvaluation here, just went down to a slight undervaluation. It doesn't matter. This would still be a better buy than up here, assuming that it's not warranted by the news that came out. This doesn't look super negative news that they hit spodumene in every hole, spodumene pegmatites in every hole. Even I can understand that's a good thing that happened. But price, despite this, went down this much. So this price decline created a 76 bagger. So I mean, again, it's really, again, it's an art, not a science. But you have to really get this. It's like easiest way again to create a 10 bagger is for a future 9 bagger to go down in price. A company with an unchanged fundamental trend, which you think could go up 9 times, when that goes down in price with no change, negative change in fundamentals, all else equal, you just know the risk reward gets better by default. Even though nobody can know exactly what's going to happen in the future, but the you'll make more if a blue sky case happens. You'll even make possibly a good return if 50% of blue sky happens. But up here you obviously need, more and more good things to have happen at the end of the day, the higher you pay. But just, think about that same stock provided any buyer with a 3 bagger and within within 1 month it presented anyone who was willing to buy with an future 8 bagger. Within 1 month an opportunity was created that is worth 10-15 years of average market returns. That is how insane this junior sector is. People don't think that's like, if a good story goes down 10% in price on a given day, you have no idea how possibly much the opportunity, how much better the opportunity has got. That 10% discount today could lead to an added 2 bagger in 3 years. At the time, people don't think much about it. They're like, oh, minus 10%. That's what I talk about, me value shuffling. And that volatility is the only currency I have. If I have 10 stories I like equally much, 2 for no reason go down 20% in price, 2 for no reason go up 20% in price. Let's say they all start off as great opportunities. Expected average return of 200%. And 2 goes down 200%. Their expected return is a lot higher than 200% all of a sudden. And the one that have gone up 20%, from then on, they have less than 200% opportunity. And the gap between those is obviously, let's say 2 stocks go from, you get some paper profits, you have, let's say, 160% expected return from there, and 2 go down in price, paper losses. Yes, the position goes down, but they're paper losses like this. So that's not a permanent loss. That's a timing thing. Because again, this was a huge paper loss until it became a 20-bagger. So it's everything is a matter of perspective. You don't know what's going to happen. The past has already happened. The investing is all about the future. Anyway, so if you have 2 stocks where you get a paper profits, let's say the expected future returns go down to 160, and you have 2 stocks that for a period of time go down in price and provide you with an open market opportunity that has gone from 200% to 240%. 240% minus 160%, that's an 80% opportunity over whatever time frame you expect those returns to play out. 80%. The market average is 8 to 9. What I'm trying to say is that don't be fooled about when you see this kind of volatility, and you see that in a lot of juniors, a lot of good juniors, the changes in opportunities, the changes in risk reward go absolutely ballistic with this volatility. It's literally like let's say the risk reward. Take this downtrend here. I don't remember the news that were out, but it's like, yeah, price might, go like this, but the risk reward goes like this. It goes exponential. And obviously the same can be said about the opposite, that okay, price just goes up linearly, but the risk reward actually goes down exponentially as well. But it's just, it's obscene. So you can think about that from, again, why I'm fully invested all of a sudden. If upturns, assuming it's like not much has happened, if risk reward goes up, what was I going to say? If, how the hell do I, yes, like this. So if prices climb with no news out really, the risk reward, this isn't even correct. The risk reward decreases exponentially, and when prices go down, the risk reward increases exponentially. So value shuffling, in my opinion, makes a lot of sense, even though, yes, you shouldn't really be trading too much. And it's like, again, it sounds like, yes, if you do this to a perfection, you'll have, I don't know how much, but it's like I make tons of mistakes all the time, have many stores that go south and yada yada. But it's like, if you grasp the important things, like the simplest way to create a 10-bagger is for a 9-bagger to go down in price, not for even better news to come out. The upside changes when value goes up or price goes down. That's why I keep saying, and I've said for a long time, that this kind of market, when what we're seeing now, where price sucks typically. Positive things don't get rewarded. But if a company that doesn't go anywhere in price, if that value over time, they put out news release, and that increased the value or de-risked, and then actually increasing value by de-risking. Let's say you have a climbing value and you have a stagnant price. The gap here, opportunity. I've done a video of this quite a long time ago. That goes exponential. If you even have declining price, it gets even more exponential. So understand this. Again, the easiest way to have to create a future 10-bagger is for a 9-bagger to go down in price today. Think about that concept. Think about that concept hard. Because then you're going to start, or hopefully you'll learn to love low sentiment environments. You will start to love when fundamentals, let's say, go one way and price goes another way. Because you have no idea how absolutely ballistic the opportunities might go. A 3-bagger within a month might become a 8-bagger opportunity. A 20-bagger opportunity within... it's like, 2 months becomes a 76-bagger opportunity. And majority of that comes from a price decline. And in this case, I would actually say, I don't know the story well, I didn't follow it too much here, but to me, at face value, it actually looks like it just got more de-risked. This was just coloring the first hole. Here's when they actually announced they hit pegmatites in every hole. And still it went down. So again, to this point here, let's say fair value was something like this. Or let's say no news was out, so it was actually like this. Yes, it became a bit overvalued here. Or maybe quite a bit overvalued. I don't know. And then this happened. All of a sudden, value jumped here. But since momentum was down, and like I talk about, that people sell because the trend is down, people buy because the trend is up. That's just how it goes. And traders obviously pile onto this, gets more people to sell, etc., etc. That's why it goes too overvalued, then severely undervalued, too overvalued, severely undervalued. You can see that in the Bear Creek chart. Anyway, so you have value actually jumping here with this news because it was de-risked. But that didn't stop people from getting scared or not thinking that there's no point in buying this because the trend is down. And like I always say, it's like almost everybody plays the game, guess the price tomorrow. People are selling here because they think another person is going to sell tomorrow. And if you have enough evidence of people selling even lower the next day, meaning that the longer and stronger a trend is, the more convinced people are that it's gonna be the right decision to sell. But in reality, they're just making worse and worse sell decisions. Because down here, maybe the price to value gap had gone up to 165% on a risk adjusted basis, down from an overvaluation by 50%. So this also goes back to my point where it's like understanding geology and fundamentals and all of that, that's great. If you're a geologist or learn about being a mining engineer, that's great. But I would take just understanding how people work and taking common sense, meaning that fundamentals change when news is out. Price is what you pay, and you have a firm grasp that price typically overshoots and undershoots, and you know why people are selling here, because they've seen evidence of people making the quote right decision of selling earlier, and they looked right for a while. And even again, this person looked super wrong. If he just held out and appreciated, okay, I might have overpaid here, but down here he appreciates that, now it's more the risk, the value is up here, I can't sell here. Now when it's going down in price, the opportunity is getting better and better. And let's say he adds, because most people again think that holding down here, for buying here, holding here is the same as buying here and buying more here. It's completely the opposite. If you've put in a buy down here, that dollar invested goes up 76 times. Even if you add 5%, you start off with $5,000 here, you add $500. I mean, your Patriot Battery Metals position is going to look completely different in terms of value at the end. $500 is going to go up 76 times. Obviously way more than your original portfolio and your position. And your original position is going to 20 bag. I mean, what is that? That's like, I don't know. A lot. That's it. So again, think about this concept. How do you create a 9-bagger? You have a 10. How do you create a 10-bagger? You have a 10-bagger, a 9-bagger go down in price. How do you create an 8-bagger? You have a 3-bagger go down in price. How do you create a 76-bagger? You have a 20-bagger go down in price. Think about these concepts. Think about the importance of price. Think about the gift of volatility. Think about when price declines, the opportunities either get exponentially worse or exponentially better, assuming there's no news out. Because if price jump and value jump, value should jump. But if if value jumped and price responded accordingly, yes, you made money on paper right now, but maybe the opportunity would be as good as it was before the price jump. So if you loved it previously and value goes up and price goes up, you should love it as much, because if the price to value gap is the same, the opportunity is the same after the jump in price. Still, again, think about this concept. Think about what this means. I'm not kidding. Think about what this means. If you can grasp this, you're going to start to love shitty markets. You're going to start to love big corrections. You're going to start to see volatility for what it is. Volatility is opportunity. The more volatile a sector is, the more you can make. Why do I love the junior sector? Because I think it's so absurdly stupid. It's so volatile. The mistakes are absolutely incredible. Absolutely incredible. The kind of, some guy bought here but sold here. I mean, it's just, 5-bagger difference within the same stock within just 1 month. It's absolutely huge when you start to be grateful of volatility. And I'm not going to pretend that I don't get rattled as well. But when you think about the common sense that, hey, the cheaper it is, the farther away I can come from, the farther from blue sky this actual target can become, and I could still make money. And if blue sky materializes, I'm going to make even more money, which means I need to be less certain of this blue sky proving up to manifest itself. It's the best offense and defense. Just keep buying cheap. The cheaper it is, the thing you have to, again, is like try to have the fortitude. Yeah, you might look very wrong for a period of time. It's like, I mean, look at some of these downtrends here. It's like, this looks like, I don't know, Head and Shoulders, let's say that broke out or broke down. Traders and yada yada. But let's say value was up here. Made no sense for a value investor to sell, but everybody got scared shitless. And all of a sudden, it's like Magna. It's like, there was a bunch of talk, about trading, etc. And prices have gone down. And of course, it's like, do you look super smart in Magna if you bought in the last month or 2 or 3 or 4? No, probably not. But it doesn't really matter. If Magna turns out to be, what management hopes it will be, and we don't know that today, but that just means that the opportunity in Magna right now, last 3 months, might be going absolutely ballistic, exponential. Again, think about this concept. Nobody almost nobody appreciates this simple concept. They think that things need to become much better. That's how a 10 bagger is created. No, a 10 bagger can be created from a 9 bagger going down in price. You can create a 76 bagger from a 20 bagger going down 70%. You can have the opportunity to get in a 8 bagger by a 3 bagger going down in price. Price declines immensely changes the future returns, and of course the upside go as well, because it's like up here it's an 8 bagger is down to 3 baggers, so you get paid let's say 10% or whatever. You get 110% in paper profits, less upside after that, of course. But then you have the option to, like, okay, if this is an 8 bagger and all of a sudden prices have gone up, you might have how much is this? A 1.5 bagger. Again, it's like when prices go higher, typically it's not exactly apples and apples, because things have gone well, so the margin of safety is at least better. So it's like up here it's probably a higher probability that this will not be worthless, whereas who knows what the news was out down here, so there might be more absolute risk here, but here the risk reward might still be, let's say, worse. I mean, again, it's like a very high chance of 100% return is worth a lot more than a low chance of a 500% return, especially if the option is like 100% downside, etc. So I mean, the margin of safety is increasing, etc. So yes, you get less upside potential, but at least the better things get, then you have kind of a sense that yes, this is still going to be at least worth something. So the chance of what they have becoming worthless decreases with price going up. Yada yada. But anyways, like I've ranted enough already. But just think hard about this concept today. How are 10 baggers created? Most of the time, because let's say there's a news release out every one day of a month. That's one chance or one day in a whole month that value changes. Any other time it's mostly price changing. So most of the 10 baggers will be created when a 9 bagger goes down in price. Not when a 9 bagger has news out that makes that 9 bagger going higher later on. No, this is actually where the vast majority of 10 baggers are created from a 9 bagger going down in price, and a 3 bagger being created when a 2 bagger goes down in price. A lot more often than when a 2 bagger sees good news that will make it a 3 bagger from there. So think about that. Then you're going to start appreciate volatility. Then you're going to be maybe end up like me. It's like I can't say no to. If we're already at, again, theoretically, if we're in 4 bagger territory on the average high quality junior at these prices, I'm not gambling. I mean, imagine if you sold down here because you thought there was a chance to get an 86 bagger. You missed that, and maybe you bought back in here or whatever. Whenever you thought that, hey, now I think the bottom is in. That's what's so hard about market timing, etc. How do you know that it's not going to go down here again when it's down here? You don't know that. Nobody knows that. But let's say you wait, you gamble, you think that, hey, this is a trend, I think it can go lower. Let's say it didn't go lower. You buy in here. First of all, you have to sit through this correction, yada yada. But let's say you buy in here. That's not a bad future return, a 47 bagger. But it's still 30 bags from what you got here. And if your reason for not buying here, even though it's like stupid cheap, things got better, price went down, is because you think you can get better. Think about how right you must be to, let's say, in theory, if you could have known it at the time, to actively say no to a 76 bagger because you thought it was gonna get better, and all of a sudden you have a 47 bagger instead. You just gave away 30 bags. Returns people dream about, because you were trying to market time. You thought that, hey, everybody that sold here have looked smart. All of a sudden it goes up, but you don't trust that, hey, I'm not sure that the trend is down. You know, last time when I bought here, I got foolish, or I feel foolish when it's down 70%. I'm not going to trust it. Then it retraces, and then you're like, yeah, look, I mean, like last time, if I would have bought, I would be stupid because it turned over. And all of a sudden, it's like a day later, it's already higher. It's like, okay, now I'm starting to sweat here. It's like, hey, when I'm going to buy in? It's like when let's say I write up companies when nobody cares, when they're cheap. Majority of people don't care at that point in time. But if it goes up 100, 200%, then they care. You know, when I put out a bunch of articles on Magna, yeah, you know, slowly people started to care about, like, yeah, I think this guy has a point. Magna looks really cheap. When it's 50 to 100% higher, that's when I actually think people like, oh, now I gotta buy it. He might have been right. I mean, that's always how it is. People get convinced when the market agrees with them. Nobody wants to buy when the market disagrees with bulls and people are whining, etc. Yeah, anyways, like that's never gonna go away. 1 in 20 actually beats an index. The best investors are dead because they don't even try to market time. So it's like, I mean, goes without saying. It's like, okay, so you're telling me if I don't do any market timing, and of course that's hard to say with juniors, but if you don't really do any market timing, you're going to be investing like a dead person, and you're going to beat your neighbor just from not market timing. Yeah, but if you actually do some smart value investing, because a dead person might not buy this, but a value investor would. And a dead person wouldn't pile in here, but maybe a value investor would not. So you would buy more here than here. But obviously the opposite happens. Like I say, people get convinced and want to buy when prices is looking like it's going to go higher tomorrow. After a long uptrend, people are totally convinced that the next week is going to be better than the previous one because there's been an endless amount of evidence of that. So the longer that happens, the more evidence they have that it will continue to do so. So people buy more and more. That's why it goes like this, and then that's why the prices go like this. So if you think this is retardedly cheap already, don't be surprised when retardedness goes exponential. But that doesn't mean that you should necessarily start to market time, because you have no idea when they're out of money. Can happen any day. Yeah, anyway, long rant. If I talked about any companies, assume I own them, assume they're sponsored. Do your own due diligence. Think for yourselves. I'm just, again, you can do technical analysis. You can do exactly what you want. I'm just trying to, again, highlight how I think, highlight some really simple concepts that is like in practice almost nobody appreciates for some reason, even though it's like when you think about it, when you just go down to common sense, it's like, yeah, it makes total sense. That of course, I mean, if a company is going to end up where it's going to end up, if price goes down, that means better risk reward, more upside for the, probably the same amount of risk, etc. Anyway, thanks for listening. Bye.